For years, people believed inflation was finally under control. Prices seemed stable, central banks appeared confident, and many economists argued that modern monetary policy had solved the inflation problems that haunted previous generations. Inflation, they said, was a problem of the past, relegated to history books and economics courses where students learned about the 1970s stagflation and the Fed's heroic struggle to restore price stability in the early 1980s. This belief was so widespread and so deeply held that it shaped how entire generations of people made fundamental financial decisions. Businesses planned for predictable costs, families built budgets around stable prices, and investors assumed that low inflation would remain a permanent feature of the modern economy. It felt as though the battle against rising prices had been won. The technological advancement and improved monetary policy frameworks had fundamentally changed the rules of economics. Inflation was something that happened to other countries, something that affected people living under mismanagement or currency collapse, but not something that Americans needed to worry about in the 21st century. Among those who believed this was a young accountant named Sarah. She had spent years carefully saving money, planning for a home, and building a secure financial future. Like millions of people, she assumed that the dollars she saved today would maintain roughly the same purchasing power tomorrow, that the compounding interest from her savings account would grow her nest egg steadily over decades, and that the financial plan she had constructed in her early 30s would work just as she had calculated. Her financial plans were based on a world where prices moved slowly and predictably, where inflation would remain below 3% annually, where purchasing power erosion was gradual enough that it barely registered in daily consciousness. Inflation was something she read about in history books, not something she expected to experience firsthand. Her spreadsheets showed savings growing year after year, calculated using 3% annual returns and 2% inflation assumptions, projections that seemed conservative based on a decade of experience. Then, almost without warning, things began to change. The cost of groceries started creeping upward. What once cost $12 became $13, then $14, then $16. Gasoline became more expensive. A fill-up that cost $50 in early 2021 cost $70 by mid-2022. Rent increased. Utility bills rose. At first, Sarah thought these were temporary fluctuations, temporary disruptions in supply chains from the pandemic that would resolve themselves as production normalized and distribution networks reopened. But month after month, prices continued climbing. What once felt like small increases of 2% or 3% monthly turned into noticeable increases of 5%, 7%, sometimes more in critical categories. What once was possible to ignore became impossible to overlook. Families across the country found themselves paying significantly more for the same goods and services they had purchased just a few years earlier. A family that spent $1,000 monthly on groceries in 2020 was spending $1,400 or $1,500 by 2023, representing devastating changes to household budgets that had no accompanying increase in income. Behind the scenes, a combination of powerful forces was driving inflation's return. Massive government spending had injected more than $5 trillion into the American economy between 2020 and 2021 through pandemic relief packages that pushed aggregate demand far beyond what existing supply could provide. Simultaneously, disruptions in global supply chains from factory shutdowns, port congestion, and semiconductor shortages had constrained the supply side of the equation. Labor shortages emerged as workers remained home longer than anticipated, and as some decided to retire earlier or seek different work. Energy costs surged as the Russian invasion of Ukraine disrupted global oil and grain supplies. Years of low interest rates set near zero had made borrowing cheap, encouraging consumption and investment far beyond what they otherwise would have been. These forces combined created a perfect environment for prices to accelerate. During economic crises, policymakers had injected enormous amounts of money into the financial system to support growth and prevent recession, understanding that demand destruction would lead to unemployment and economic collapse. While these actions helped stabilize the economy and prevented the catastrophic depression that many feared, they also increased demand at a time when supply struggled to keep up. The Federal Reserve maintained interest rates at virtually zero through 2021 and into 2022, kept inflation expectations artificially low through repeated messaging that elevated prices were temporary, and continued large-scale asset purchases that expanded the money supply. The result was a surge in inflation that caught many experts by surprise. By June 2022, inflation had reached 9.1%, the highest in 40 years, catching nearly every major central banker and economist off guard. Federal Reserve Chair Jerome Powell and other monetary policy officials had consistently stated that inflation was transitory, that it would resolve itself as supply chains normalized and pandemic-related distortions faded. That expectation proved catastrophically wrong. Inflation did not resolve. Instead, as supply chains began normalizing, continued aggressive fiscal and monetary stimulus ensured that demand remained so elevated that prices continued climbing. By the time policymakers acknowledged that inflation was not transitory but rather a serious problem requiring immediate and dramatic policy response, inflation had already become embedded in expectations, with consumers and businesses assuming continued price increases would occur. This shift in expectations is perhaps the most dangerous moment in inflationary episodes. Once people begin expecting higher prices, they demand higher wages, reduce savings, and bring forward purchases before prices rise further. Sellers, expecting input costs to increase, raise prices preemptively. This self-reinforcing cycle of expectations-driven inflation becomes extraordinarily difficult to break without causing severe economic damage. As inflation continued rising through 2022 and into 2023, central banks finally faced the difficult challenge they had avoided throughout 2021. To slow price increases, they began raising interest rates aggressively. Starting in March 2022, the Federal Reserve raised its benchmark interest rate 11 separate times over the next 16 months, increasing the federal funds rate from near zero to a range of 5.25 to 5.50% by July 2023. This represented the fastest rate increase since 1980, a pace that surprised markets and caused considerable economic disruption. Borrowing became more expensive. Mortgage payments increased dramatically. A 30-year fixed-rate mortgage that averaged 3.22% in January 2022 had jumped to 7.08% by October 2022, and eventually peaked at 7.79% in October 2023, the highest in more than 20 years. This meant that a $500,000 home purchase that would have required a monthly payment of $2,100 at 3% interest required a monthly payment of $3,300 at 7% interest. Financial markets reacted with volatility as investors tried to predict the future path of policy and interest rates. The stock market declined nearly 20% in 2022 as the combination of higher rates and recession fears sparked broad-based selling. Tech stocks declined even more dramatically, with many falling 50 to 70% as investors recalculated valuations in a higher interest rate environment. Bonds, considered safe assets, declined sharply because bond prices move inversely to interest rates. Suddenly, inflation was no longer just an economic statistic or a concern for financial engineers. It was influencing nearly every aspect of daily life, reshaping how people saved, invested, and planned for the future. Sarah soon realized that inflation affected more than prices. It changed how people saved, invested, and planned for the future. Money sitting in a savings account earning 0.05% in 2020 gradually lost purchasing power when inflation reached 9% in 2022. The calculation that had seemed conservative in 2020 became wildly optimistic. Savings accounts, once considered safe places to park money, began to feel like vehicles for losing wealth. Meanwhile, assets such as stocks, real estate, and commodities often behave differently than inflation itself. Real estate, particularly existing homes and rental properties, tended to appreciate alongside inflation as construction costs rose and landlords passed higher costs through to tenants. Stock prices, heavily dependent on corporate earnings expectations, initially fell during the inflation shock but eventually recovered as investors realized that many companies could raise prices and maintain or expand profit margins. Precious metals like gold, which had historically served as inflation hedges, surged to record highs as investors sought tangible assets with finite supply that could not be debased through monetary expansion. People who understood inflation adapted their strategies, moving money out of savings accounts into higher-yielding vehicles, accelerating real estate purchases while they could still qualify for mortgages, buying commodities and precious metals as portfolio insurance. Those who ignored inflation or failed to understand its implications found themselves falling behind financially, their savings eroded by rising prices, their purchasing power diminishing, their long-term financial plans disrupted by assumptions that had proven spectacularly wrong. The comeback of inflation became a lesson in humility for economists, policymakers, investors, and ordinary citizens alike. Economists had to confront that their models had failed, that inflation persistence was poorly understood, and that factors they had dismissed as temporary proved remarkably sticky. Policymakers had to acknowledge that years of near zero interest rates and massive fiscal stimulus had been excessive, that their communication about the temporary nature of inflation had been wrong, and that economic management was far more uncertain than they had claimed. Investors had to accept that diversification strategies built on the assumption of low inflation had failed when all assets declined simultaneously. Sarah had to confront that the careful financial plan she had constructed had been built on assumptions that had proven false. What made inflation's return so remarkable was not merely its size, but the fact that so few people expected it. Economists had constructed entire models of the world based on assumptions that inflation had fundamentally changed, that it had been defeated through better monetary policy frameworks, that modern central banking had solved the problem. Some pointed to the success of the Federal Reserve in the Volcker era in breaking the back of 1970s inflation, arguing that this knowledge meant inflation would never approach those levels again. Others pointed to technology and globalization, arguing that falling prices for imported goods and technological disruption would prevent inflation from ever becoming a significant problem again. These arguments seemed compelling until 2022, when they were proven dramatically wrong. The inflation surge had consequences that rippled through society in ways that went far beyond simply paying more for groceries. For families with young children, the increase in housing costs was particularly devastating. Home prices had surged during the pandemic as remote work, low interest rates, and pandemic savings converged to create enormous demand. A median home price of $380,000 in 2019 had risen to over $420,000 by 2022, yet the real shock came from interest rates. The monthly mortgage payment for a median-priced home with 20% down and a 30-year fixed mortgage had been approximately $1,600 in 2021. That same payment in 2023 was approximately $2,700, a 70% increase in borrowing costs that pushed homeownership out of reach for millions of younger Americans. People in their 20s and 30s, who in previous generations would have been able to purchase homes in their late 20s or early 30s, found themselves unable to qualify for mortgages or unable to afford monthly payments even when they did qualify. This had profound implications for wealth accumulation, as homeownership had been the traditional way Americans built wealth. Renters were equally devastated, as inflation in rental markets nearly matched inflation in home prices, with rents rising 20 to 30% in many markets between 2021 and 2024. The elderly and retirees experienced different but equally devastating consequences. Those living on fixed incomes that did not adjust for inflation found their purchasing power declining year after year. A retiree receiving a fixed pension of $3,000 monthly in 2020 was receiving payments of the same nominal amount in 2024, while the cost of living had increased 40%. Even Social Security recipients, whose benefits did include cost of living adjustments, found that the adjustments lagged actual inflation in the categories where they spent most money. Energy costs for heating and cooling, medical care expenses, and food costs rose faster than headline inflation, meaning that COLA adjustments based on broader inflation measures did not fully protect purchasing power. Bonds, which had been the traditional safe asset for retirees, declined sharply in value as interest rates rose. A retiree holding 10-year Treasury bonds purchased at 1% yielding bonds had suffered mark-to-market losses exceeding 20% as interest rates rose to over 4%. The combination of falling bond values and fixed income eroded wealth and forced many to make difficult choices about retirement spending. Lower-income households were hit particularly hard by inflation because they spent larger portions of their budgets on necessities that experienced faster inflation than discretionary items. A household earning $30,000 annually might spend 25% of their income on food and energy, categories that experienced 8 to 10% inflation. A household earning $150,000 annually might spend only 8% of their income on those same categories. This meant that the same 9% inflation rate devastated lower-income households, while barely affecting upper-income households. Studies by the Federal Reserve Bank of Cleveland found that households in the bottom 40% of the income distribution experienced inflation that was 1 to 2 percentage points higher than headline inflation, while the top 20% experienced inflation that was actually slightly lower than headline inflation. The disparities were driven by consumption patterns, as lower income households spent more on necessities, while higher income households spent more on services and discretionary items that experienced lower inflation. Wage growth, which had accelerated alongside inflation, eventually helped lower income workers recover some purchasing power by 2024, but the period of 2022 through early 2024 had been devastating for people on limited incomes. The shift from goods to services that occurred during the pandemic also drove divergent inflation across the economy. During lockdowns, consumers could not spend on services like travel, dining, and entertainment, so spending surged on goods. This created massive supply chain bottlenecks as factories worldwide tried to keep up with extraordinary demand for physical products. The surge in goods demand drove inflation in goods categories to over 12% by early 2022. As the economy reopened and vaccines became widespread, consumers shifted spending back toward services. This rebalancing of demand from goods to services gradually reduced goods inflation, while pushing services inflation higher. By 2023 and 2024, goods prices were declining or rising slowly, while services prices continued increasing due to rising labor costs and renewed demand for travel, dining, and entertainment. This sectoral rotation meant that different households experienced quite different inflation depending on their consumption patterns. Families with young children, who spent heavily on childcare and education services, experienced different inflation than families of retirees who spent more on healthcare services and home energy. People who understood inflation adapted their strategies and found ways to protect their wealth. Investors shifted allocations toward assets that benefited from inflation, purchasing real estate at a faster pace despite rising interest rates, buying commodity-related investments that benefited from energy price increases, and accumulating precious metals. Gold prices surged from $1,800 per ounce in 2020 to $2,700 and beyond by 2025, driven by central bank purchases, geopolitical uncertainty, and inflation expectations. Real estate investment trusts surged as investors sought exposure to physical assets that would benefit from rising rents. Dividend-paying stocks from companies with pricing power, such as utilities, consumer staples, and healthcare companies that could pass costs along to customers, outperformed broader market indices. Dividend aristocrats, companies that had increased dividends for 25 or more consecutive years, attracted significant capital flows as investors sought income that would grow with inflation. Those with access to investment capital could buy properties, accumulate precious metals, or shift portfolios toward inflation-resistant assets. Those without such access, living paycheck to paycheck and unable to save, had no such options. The Federal Reserve faced an extraordinarily difficult balancing act in managing this inflation crisis. Raising rates too slowly would allow inflation expectations to become unanchored, potentially leading to a stagflationary scenario where high inflation persisted alongside weak economic growth. This had happened in the 1970s, when policymakers had raised rates too cautiously and inflation had become deeply embedded in wage and pricing expectations. Raising rates too quickly would risk triggering a severe recession with massive job losses, foreclosures, and economic damage. The Fed chose an aggressive path, raising rates by 5 percentage points in 16 months, the fastest pace in over 4 decades. This aggressive tightening squeezed inflation downward, but it also caused considerable economic stress. Housing starts plummeted. Commercial real estate defaulted on loans, as higher mortgage rates made properties unprofitable. Credit card delinquencies rose as consumers struggled with higher borrowing costs. Bank deposits fell as people moved money to higher-yielding alternatives, causing concerns about banking sector stability that briefly materialized when 3 regional banks failed in March 2023. Yet somehow, the economy remained resilient. Unemployment stayed low. Consumer spending, contrary to most forecasts, remained strong. The labor market remained tight. The Fed ultimately achieved what many economists thought impossible, a soft landing where inflation declined toward 2%, while the economy continued growing and unemployment remained low. By late 2024 and into 2025, inflation had moderated substantially. The Consumer Price Index inflation rate had declined from 9.1% in June 2022 to 2.4% by January 2026, almost exactly at the Federal Reserve's 2% target. The Fed began cutting interest rates starting in September 2024, reducing the federal funds rate by 50 basis points in September and by another 75 basis points through the end of 2025, bringing rates back down toward 3.5 to 3.75%. Mortgage rates, which had peaked at 7.79% in October 2023, had declined to approximately 6% by mid-2025, easing some pressure on housing affordability, though prices remained elevated relative to historical norms. Gasoline prices had fallen from their 2022 peaks, averaging around $3 per gallon by early 2025, representing a dramatic decline from the $5 per gallon seen in mid-2022. Food prices had stabilized after years of increases. Labor markets had cooled from their 2022 intensity, with wage growth decelerating toward levels more consistent with moderate inflation. The acute phase of the inflation crisis appeared to be passing, yet the experience had profound implications for how people thought about money, saving, investing, and planning for the future. The inflation episode of 2021 through 2024 had revealed that the supposedly permanent low inflation environment of the 2010s had been artificial, maintained through extraordinary policy accommodation, and benefiting from globalization trends that might not persist indefinitely. It had revealed that inflation could return suddenly, that even sophisticated economic models and policymakers could be caught off guard, and that the purchasing power of money could not be taken for granted. The episode had demonstrated that those with assets, those with the ability to access credit, and those with flexible income benefited from inflation and even profited from it, while those without assets and those on fixed incomes suffered. The wealth gap had widened as a result of the inflation cycle and the policy responses to it. Those who owned homes before the inflation surge found their property values and home equity surging. Those who had bought stocks at depressed prices in late 2022 found their portfolios surging as equities recovered in 2023 and 2024. Those who had accumulated precious metals as insurance found their positions appreciated substantially. Those who had simply kept their money in savings accounts or bonds had watched their purchasing power decline, and their investment returns failed to keep pace with inflation. The episode had demonstrated that the value of money was never guaranteed, that the forces shaping its value remained as powerful as ever, and that complacency about inflation was profoundly dangerous. It was a lesson that would shape financial decision-making for a generation of people who had lived through it.